Good afternoon, ladies and gentlemen. On behalf of the Institute of Directors India, it is my distinct privilege to welcome you to the IODGlobal webinar series on the theme Financial Acumen in the Boardroom for Good Corporate Governance. My name is Kashish and I shall be your co-host for today. In today's rapidly evolving business landscape, financial literacy is no longer the exclusive domain of financial professionals. It is a core competency expected of every director and senior executive. An informed understanding of financial statements, risk indicators, capital allocation decisions, and performance metrics empowers boards to exercise sound judgment, strengthen accountability, and contribute more effectively to long-term value creation. We are pleased to have with us an eminent panel of experts who bring rich experience from the domains of finance, governance, leadership, and corporate strategy. As we move forward in today's session, it is my privilege to welcome a leader whose vision and stewardship have been pivotal in strengthening the discourse of corporate governance and boardroom. We are honored to have with us Mr. Manoj K. Raut, CEO and Secretary General of Institute of Directors India. May I now request Mr. Raut to kindly deliver the welcome address.
Good afternoon, everyone. Our esteemed speakers of today's webinar, respected IOD members, IOD family, distinguished guests, ladies and gentlemen. A hearty welcome to each one of you to this important IODGlobal webinar on financial acumen in the boardroom for good corporate governance. Today, I'm very glad to learn that we are joined by a large number of senior executives and board members from India and also various parts of the world, so where we have the membership base. So this remarkable participation, it reflects a growing realization across the world that governance excellence begins not merely with the compliance, but with the competence. I extend my sincere gratitude to all our esteemed speakers as they are going to provide us invaluable perspectives, practical guidance for directors, for the board members, how to elevate governance standards in board functioning. Ladies and gentlemen, I would like to begin with a simple but uncomfortable question. How can a board safeguard shareholder value without financial understanding? Can a board truly govern what it doesn't fully understand? History has repeatedly shown us that some of the world's most respected and well-known corporations didn't fail because they lacked strategy, nor the talent, nor technology, nor ambition. They failed because the boards failed to ask right questions. They failed because the warning signals were overlooked. They failed because the financial complexity outpaced board understanding. And ultimately, they failed because governance became procedural rather than purposeful. Today, we all are aware that boardrooms stand at the crossroads of unprecedented change. Geopolitical uncertainty is reshaping markets. Technology is disrupting the business models. Artificial intelligence is also at the same time helping transforming the decision-making. Climate risks are becoming the financial risk. Cyber threats are escalating. Stakeholder expectations are also multiplying at the same time. And in this age of social media, where corporate reputations, those are built over several decades, they can be damaged or even destroyed in a matter of minutes. A single governance lapse, ethical failure, or financial misjudgment can trigger immediate scrutiny from investors, regulators, customers, shareholders, and the society at large. So in this complexity of environment, financial acumen is no longer a desirable skill. Rather, it is a boardroom necessity. At the same time, as the independent directors take up increasingly demanding responsibilities, financial literacy has emerged as one of the defining competencies of effective board leadership. The modern director is expected not only to read the financial statements, but to understand what lies beneath them. So they are not there not merely to approve the budgets, the financial statements, but to challenge the assumptions. Not merely to protect the shareholders' value, but to safeguard the stakeholder trust. So financial literacy today is the language of effective governance. Without it, oversight becomes superficial. Without it, even the boards with good intentions may fail in its fiduciary responsibilities. As Warren Buffett, famously said, this comes from not knowing what you are doing. So at the Institute of Directors, we firmly believe that the strength of an organization is ultimately reflected in the strength of its board. That is why today's discussion is so important. Over the next couple of hours, we are going to explore how boards can strengthen financial oversight, accountability, and how that we can build financially informed board cultures and reimagine the board committees in a high risk, the digital economy, improve the integrated reporting, and how to draw lessons from various the governance failures, corporate collapses around the world as we read them when it hits the headlines. So for any corporate and the board, corporate governance is rarely discussed until it becomes a media headline. So I'm confident that the collective wisdom of our distinguished speakers will provide not only valuable insights, but also practical guidance for every director committed to boardroom excellence. So before I conclude, allow me to leave with you one final thought. Good governance is not built in times of crisis. It is built long before the crisis arrives. Thank you all once again for joining us, and wish you all a stimulating, insightful, impactful session. We have such a distinguished leaders. I'm grateful to the chairman of the Saraswat Bank, India's the largest urban cooperative bank and one of the fastest growing cooperative bank, Mr. Gautam Thakur. He was kind enough to join us to deliver the opening theme address, followed by Mr. Nilesh Shah, who is the managing director of Kotak Mahindra Asset Management Company. We have a very dynamic or masterclass mentor and the leader who has been part of our boardroom, the masterclass sessions, the leader, Mr. Jayaprakash. We fondly call him as JP. And so we have the panel session that includes Ms. Susmita Ghatak, who is she's an independent director on multiple boards, and also she was a MD and CEO of ICRA Analytics. And we have Ms. Aarti Powell. She is the country head for CFA Institute. And we have Dr. Abhishek Agarwal, managing partner of Asian. So thank you all once again for joining us and looking forward to this learning session. Over to Kaushik. Thank you.
Thank you so much, sir, for those insightful words and for highlighting the growing importance of the imperative, that is the financial acumen and its growing need in contemporary boardrooms. Now, ladies and gentlemen, it is my singular privilege to introduce to you our first distinguished. Allow me to introduce to you Mr. Gautam Thakur, who is the chairman of Saraswat Bank, and as sir rightly mentioned, the largest urban cooperative bank that we have in India. And he has been kind enough to deliver the opening theme remarks. But firstly, a little something about the distinguished career that commands this gentleman. Now, Mr. Gautam Thakur is a distinguished leader with extensive experience spanning banking, regulation, entrepreneurship, and governance. He serves as a member of the advisory group on regulation, constituted by the Reserve Bank of India, and was previously a member of the RBI's advisory group to the Regulation Review Authority. A respected voice in industry and public policy, he also served as the former Vice President of the Maharashtra Chamber of Commerce and Industry. Mr. Thakur is a professor of practice and mentor at PTVA's Institute of Management. A long standing supporter of IOD, it is my privilege to invite him to address the gathering and set the context for the session and deliver an opening theme address for this crucial exchange.
Ashish, and thank you, Raut sir. This has been at a short notice, but I'm privileged to be here. It's always a pleasure to be on any panel or any engagement with aspiring or present directors who are part of IOD. Distinguished participants of this webinar on financial acumen in the boardroom, it is an honor to address you on a subject that sits at the very heart of sound corporate governance. As Raut sir mentioned in his opening remarks, we are increasingly seeing a very volatile geopolitical world, and there are challenging business headwinds. There are evolving regulatory expectations. At the same time, there are systemic risks which are moving from one balance sheet to the other at a speed which we have never seen before. This is as the world is becoming closer, we are seeing that the contagion risk which spreads from one balance sheet to another is growing day by day. And in such an environment, the question is no longer whether the board should possess financial understanding. The real question is how deep and how applied should that understanding be. Here, friends, let me draw a distinction between which is very fundamental in nature. Financial literacy, as we all know, is the ability to read a balance sheet, understand basic ratios, and any financial information. But financial acumen is something of a higher order. It is the capacity to exercise judgment, to ask the right questions, as Raut sir was mentioning. For instance, why is the net profit margin compressing when sales growth appears robust? You could also question assumptions in a capital adequacy model. So to read and understand figures is one thing, but to question them requires acumen. And acumen comes with pattern recognition, with the intellectual courage to ask uncomfortable questions. Basically, financial acumen is about understanding the story behind the numbers. You will be able to, with financial literacy, understand the numbers, but acumen will come only when you understand the story behind the numbers. The consequence of absence of financial acumen is even felt in financial institutions. If you feel that in financial institutions there are board full of people having financial literacy, there have been several examples in the past where these boards have been found wanting. One of those cases is already there, I think, in the syllabus for the independent directors examination, which is about from my sector, which is Punjab and Maharashtra Bank. I think that is part of the syllabus where one has to go through it as a case study. Now, it's not the case that there was not a board sitting there who was financially literate, but obviously they didn't look at the concentration risks and which was building up. That is why RBI had to later on bring the fit and proper criteria, because in cooperatives, the directors are elected and not selected. So if the directors are elected, then they at least have to be fit and proper. So there is always a regulatory response to such failures. Now, not only cooperatives, in PSU banks also, you must have heard about the famous twin balance sheet problem, where over-leveraged corporates, that problem mirrored in the balance sheets of the banks as well, and it took years to clean that up. Now, this also didn't happen in one day. This was a successive cycle of credit approvals where boards, couldn't see what was going to come, and that was because of a lack of financial acumen. I would argue that the problem is even more acute outside financial services. See, in the financial sector, institutions, by now there is an ambient culture of credit discipline, regulatory scrutiny, and risk vocabulary in general. That institutional scaffolding does not exist in other sectors. I increasingly see in manufacturing, infrastructure, healthcare, technology, uh, board members are typically drawn from the operational or technical or functional backgrounds, which is a good thing because their expertise is genuine and really necessary for the boards. But it does not automatically confer, uh, the financial judgment that the complex capital structures demand. I will give you four examples. Consider India's infrastructure space. Several large project uh, managing companies collapsed under debt burdens. This wouldn't have happened had the boards of these companies exercised better scrutiny and flagged, what could have been the problems. There were construction cost overruns which were funded by fresh borrowings, which compounded leverage further, and they got into serious trouble. Consider some manufacturers which were anchored in very optimistic receivable cycles. That did not materialize, and we saw that there was liquidity stress in those manufacturing companies. Consider some healthcare companies where there were early warning signs of cash flow deterioration. I know one or two cases where there were receivables from some government schemes, but they could have seen it coming far earlier, but that was not there because the acumen was missing. There were some pharmaceutical companies which had ran into problems because of export correction lag. Okay, so now these boards were full of people with expertise in those industries, but there might be, of course, other finance professionals also. But in each case, the failure was not of intent; it was the failure of financial understanding and acumen, because all these issues which were apparent went unchallenged at the board level until the stress became a crisis. So this raises structural questions that with RBI and SEBI, at least, there are defined standards of competence and oversight. In non-financial sector boards, there is no such equivalent because the regulators there are, perhaps not holding these uh, boards to account in terms of the standards expected in terms of the financial acumen. Therefore, this discipline must be self-imposed. It is these boards, especially non-finance companies, that must have a thorough and deliberate, board composition with, experts from different fields. And they should also, those who are not from the finance field should acquire financial expertise apart from their operational knowledge of these very industries. Now, of course, the listed companies, as required by SEBI and the Companies Act, have audit committees because regulators have learned repeatedly that governance without financial depth is governance only in name. But friends, regulation only sets the floor. It doesn't, set the ceiling. It is for the companies to work from that floor. Boards today are navigating a very complex landscape because they have to look at capital allocation, technology investments, risk management, acquisitions, sustainability commitment, and all of these have profound financial consequences. So, what is required in board today are not batsmen or bowlers, but all rounders. We shouldn't have only people with one kind of. So, you might be an expert in your area, you might be an expert in quality, or you might be an expert in manufacturing or technology, but until and unless you develop the financial acumen, you will not really be an efficient board member. Let us say you are part of a technology committee, let's say IT strategy committee, or whatever name you would like to give it. There are going to be huge financial implications of all that you undertake there, and you must be able to appreciate what is how it is going to impact your institution. Therefore, directors are not only expected to demonstrate independence in today's world, they are also expected to demonstrate competence, whether it is in their own field or whether there is the understanding of financial matters. Friends, India's economy is entering into a significant transition in markets, in regulation, and even in the expectations placed on institutions across sectors. The board will only be able to serve their stakeholders well by not just oversight, but good financial acumen. A financially strong organization starts with a financially wise board, and wisdom comes only after developing acumen. The first stage is develop the acumen. First stage is maybe the literacy, then it is acumen, and then there would be wisdom. So, those of you here who are from a non-finance background have nothing to worry. Financial acumen can be, acquired. You need not be a chartered accountant or an auditor for that. There are very good programs. Even I've seen the programs at IOD where you can uh, attend those programs and develop financial acumen. On a lighter note, take heart from the fact that there are engineers like me, and I know of some of my friends who are, masters in philosophy or something, and who are today in the banking industry, which is considered as a financial industry, and we are occupying very high positions there. So if you have survived applied mechanics or philosophy in college, I will tell you that financial uh, understanding is not all that complex. You will be able to do it, or you are already an expert in your own areas of competence. All that you need to do is to take the first step in acquiring financial acumen and be an all-rounder. My best wishes to all of you. If there are any questions, I'd be glad to take them. Thank you so much.
Thank you so much for that insightful address, sir. We are deeply grateful for the wisdom and experience that you bring to the forum. And of course, I'm sure that the audience and their stimulated interests would really wish for having an opportunity to engage with you. So may I request our moderator for the day, CA Jayaprakash Rajangam, who is an independent director on multiple boards and a professional mentor and advisor on finance, risk management, and governance, to steer the conversation further by taking up questions from the audience, please.
Sure. Thanks, Kashish. And good day, Mr. Thakur. It was lovely to hear you speak about finance, and specifically from the background that you mentioned, from an engineer to a financial acumen journey. I would like to take the liberty of posing that first question to you. If I have to, in very quick summary, say how in your early formative years was this transition from an engineer, specifically, if I may say so, while there is a family background or there is that undercurrent underpinning DNA, but what are the key things that in your formative years you thought was the most difficult for you to absorb to move into banking from your background? If I may, I would surely want to listen some bit of that.
Both, my parents both have been bankers. My mother retired as a CGM of State Bank of India. My father was also a banker. He was on the board of SBI. So every day on the dinner table, there was talk about CASA and CD ratio or something. So me and my sister decided to run away from it. She became a doctor and I became an engineer. But while I was studying engineering in Pune, I realized that many entrepreneurs, they might be brilliant engineers, but they struggle in, putting up their businesses because they lack this knowledge in finance. And I decided I wanted to, of course, I got good marks in GMAT and I would have gone to America, but I wanted to add that entrepreneurial bug which had bit me. So I wanted to start my business. So I went to an institute there, which was a management institute, and I told them I want to do a postgraduate diploma in finance. But they told me that you are not a graduate. I said, I don't want your degree. I want to study this. You can give me your degree after the diploma after I complete my graduation. So the director there was very surprised, but uh, understanding my passion for learning, he allowed me. And then I completed my diploma in financial management there. Along the way, there was Gokhale Institute next door, which is a a great institute for learning economics. So I made friends there and I was learning that along the way. So my point here is, you see, do not be held back by your qualification. Acquire whatever knowledge is required. There are various, you need not necessarily have a degree in that. For instance, today, in my own bank, there are about 200 odd chartered accountants and these things. So it's not that your qualification will determine what you know. It is what amount of investment are you willing to make to learn something that you do not understand. If you go after that, it will definitely help you. And these labels, you should never stick those labels to yourself that I'm an engineer, I'm a banker, or I'm a this thing. You must keep on exploring new areas, because whatever you learn otherwise also will have a positive impact on what you are doing.
That was quite a story, sir. And we are glad that you made it where you made it and when you made it, because we know the role that you've played in taking Saraswat Bank to where it is today. I'm afraid JP sir's network is a little patchy, so I will take the liberty of reading the questions that have been posted on the chat.
Yes.
We have a question that reads, how is the AI used to analyze all the financial statements and derive a very tough and relevant question, which also mainly is not on the auditor's note of the annual report? So primarily about AI's role and how it can sometimes come in direct conflict with auditors' roles.
There is a question which has to be answered at various levels. First is that the auditor is going to write in his report what he is supposed to write as per various standards. The standards of auditing or whatever are the standards of reporting. Please understand that AI needs a prompt, a question. So basically, the intelligence, even if we call it artificial intelligence, ultimately what to ask AI cannot come until and unless you have some financial acumen. Until unless you develop the skill of reading between the lines, of understanding the story behind that numbers, you will not be able to ask the appropriate questions to AI. And only when you are able to do that will AI be of use to you. That is my studied opinion of this. Because otherwise, reading a balance sheet, let me tell you, it's not something which you can only learn from a course in accounting. You have to basically understand it like an art form. You know, I know of people who even do not have a commerce degree, but they know they are big businessmen today. They understand the balance sheet in a totally different way and a totally different context, which is the entrepreneurial context. So the same balance sheet is read by different people in different ways. So what I mean to say by all this is that acumen is something that you need to develop first. Okay, reading statements is something which is part of literacy.
If I have to slightly push it to a slightly different agenda, if I may, if you have been involved in the cooperative segment for so long, last year was defining for as 2025. Summarily, if I have to ask you, what were the things that a cooperative sector banking board had to, a board member had to understand or change themselves to adapt to the substantive change that happened in 2025? Your words on that would be, again, helping us examine from a different angle.
So I would say that a cooperative bank is different from other banks in terms of its constitution. Okay, so the capital comes from its members. But as a bank, although we have a different set of regulation, a cooperative bank like Saraswat Bank, which has a balance sheet of more than 1 lakh crores, is very akin to a proper, otherwise a universal bank, right? So in our board, we follow almost all the regulation which is there for commercial banks. Like even when for there was risk-based audit was not compulsory for cooperative banks, we adopted that long ago. Even in terms of technology adoption, we are far ahead because you know we want to see cooperation is our DNA. That is our constitution, right? But it doesn't stop us from adopting the best practices which are available in other these things also. And that is the only way you can compete in the market. Nobody gives you any business because you are a cooperative or you're a universal bank. Ultimately, for a customer, in fact, it is difficult for a cooperative bank to get business because there are some banks with poor governance track records. But in spite of that, the good ones are growing.
Indeed. So
last year, if I may add, was a milestone year for cooperatives because Saraswat as well as Amul crossed the 1 lakh crore balance sheet mark. So, two institutions which are cooperative where there is no, you can say, private equity or, this has been, the shareholding is by members.
Yes, indeed. It's kudos to you and kudos to Amul too. I personally, I'm a big vociferous fan of the cooperative movement. Personally, that's the only way to get the larger masses up and running. So truly respect, and I believe it calls for all of us to together acknowledge as participants in this profile to be in this forum, to be able to listen to the person who created that vision from 19,000 crores to 5 times growth for Saraswat Bank. I respect that. I'm just checking further. AI is done. Someone has indeed managed to also, say the same thing. Chemical engineer retired as CFO of a bank. So we have someone with similar background there too. If I may slightly ask you a remark from a reporting angle. With adoptions, AI was indeed mentioned, but too much of information can also sometimes be counterproductive. So, as board members in a financial services company like yours, or you would have observed other boards too, how much is too much, or how less? How would you define that balance? Because our pride comes in when it comes to your on board. So, how does one manage that balance? What would be your thought or experience on that? How much is too much, or how much is less?
As you have already mentioned, I am a part of the advisory group of regulation. And if you have read the recent circulars, what is expected of the board is that, and especially of the chairman of the board, is that the chairman should set the agenda. It is totally in the hands of the chairman as to what kind of information and how much of it must be coming to the board or its committees. So clearly the onus is on the board as to what exercise they are wanting to, oversight they are wanting to exercise. And otherwise, it will be not a good idea for the management to set the agenda. Usually what happens, I see in companies and many other things, is that management sets the agenda for the board, and as though the board has been given a syllabus for the board meeting, and they at home they read it and they come prepared to give an examination. That's not the way. It is the board which should set the agenda. They should ask the right questions. They should call for the right information and follow up information. That is the only way to exercise oversight.
So you'd strongly recommend that as a parent-child relationship, the board always is the parent and guiding the child, which is the management, through all its functions, if I may use that terminology.
That is very well put. I would say that the parent should allow the child to, have his play, but put in strong guardrails. That's all.
In these days and times, indeed, I do agree. I do agree.
So they can post the questions on the chat. We shall take them up later now.
Yeah, fair, no issue. So, Mr. Rajneesh, if you have a question, I could post your message. What I would also, one of the key themes that we are trying to also examine as a part of panel discussion, and that you are there, it helps me to build that and move into that, that role. You have, through your training approach, it's often quoted in the marketplace and in multiple publishing also, that you have yourself sponsored people to go into IIM from your own, set of people, and you also are part of multiple institutions promoting financial literacy or training per se.
Yes.
So if I have to ask you a slightly different, how much training would be, should it be a regular periodic training, or should it be once and a refresher once in a few years for someone to have financial acumen on in an evolving world? How much training would play a role, and how regular or frequently would you advise people to go revisit their understanding of finance or in business in general?
Well, as you know, it is the Nomination and Remuneration Committee, NRC, which is ultimately, in my opinion, you know, should take stock of the talent in the board. You might get in good people who could be in an engineering company. They could be great engineers or this and that. But of course, so that they become effective board members, the chairman of the NRC or the NRC committee itself should take an interest and see to it that particular board member should be given an opportunity maybe to attend courses at IOD, or read particular. For instance, when I get in a new member on my board, I advise them to read 2 3 books. That yes, you have to read this book, and that will help you. Boards That Lead is a very good book. Prahlad, you have read that.
Boards That Lead. I will repeat for everyone. So all those you're hearing, yeah.
Yeah, that's an old one, but it's really what it tells you what one should do in a board.
Sir,
Or
old school is good school, sir. Old school is
pardon?
good school. Old school is good school.
Old school is good school, but yes, the thing is that it doesn't tell you the technicalities of what is being done in the board, but it tells you as to what is expected of a board. What should the board strive to do? Where should one, I mean, that's the way we were trained in our years. We didn't have schools and this thing. You read and read. For instance, corporate governance, Pal Subramaniam. If you read that book, it's an authority. So if you want to make a career as a board, this one, it is not only getting the qualification, right? It is you must devote yourself to that field. There are many good courses, books available today. It all will depend on the director whether he wants to stick to his past laurels that and that he has achieved. I always tell a board member that when the person has joined, that today you have become a member of the board, now becoming deserving of that position.
A fair qualificatory statement, sir. Point taken. With on that note, rather, I will say it was a lovely note for us to pick up the string from moving from being a member to being a deserving member. I guess that's a transition that I would pick up as a key thought, other than all the other things that you did mention about story behind numbers and the distinction between what we focus. Even in IOD, our sessions are named currently Financial Literacy for Directors. But I would surely say, as a finance so-called intervention provider, we will adopt the financial acumen as a terminology going forward at IOD too. So, point taken. Thank you so much for your time, Mr. Thakur. I hope you will continue to be with us and participate, should time permit, on the panel subsequently too. But Kashish, back to you before we play before the next agenda on the forum. Yeah.
Thank you so much. I'll take your leave. I have a board meeting to attend.
We appreciate. Thank you so much, Mr. Thakur, for being there. Yeah.
Right. What an insightful session that was. Wish we could have more of it, but in the interest of time, we are going to have to now move to the next segment. And for the next segment, it is my honor and privilege to again introduce a distinguished guest and industry leader. And we were privileged to have him deliver a special address. So let me take this opportunity to welcome Mr. Nilesh Shah. Mr. Shah is currently Managing Director of Kotak Mahindra Asset Management Company Limited and is a widely respected leader in India's financial services sector. With over 25 years of experience across investment banking, asset management, and capital markets, he has held leadership roles with the Axis Bank Group, ICICI Group, and Franklin Templeton Mutual Fund. His expertise spans debt, equity, and real estate investments across domestic and global markets. Mr. Shah currently serves as chairman of the Association of Mutual Funds in India and is a member of SEBI-constituted Mutual Fund Advisory Committee. A gold medalist chartered accountant, he is also a noted commentator on the Indian economy and financial markets and co-author of A Direct Take on Financial Planning. Ladies and gentlemen, unfortunately, an exigency precludes Mr. Shah from joining us, but he has been kind enough to share a recorded message so that all of us gain the privilege from his insights. So I'll now request the team to play Mr. Shah's theme address, please.
At the board level, there is confluence of talent. Undoubtedly, we need people of different background, and their financial literacy is unlikely to be of a similar level. However, collectively, the board must define boundaries within which management is supposed to operate. Many a times I have seen board expects management to behave prudently and don't define boundaries. That results into excessive risk taking, be it leverage, be it asset liability mismatch, be it on treasury operation. The management feels they are trying to optimize return. They forget about risk. The board believes management is behaving prudently and fail to put brake when there is a need. I think the board must play its role in setting the rules, defining the boundaries, and selecting the best players. Then it is up to management to go and play and win the game. The regulator and government believes there should be no mishap. Whenever there is a mishap, they want to fix accountability. Obviously, one cannot argue against that. Sometimes there are genuine errors. Sometimes there are willful fraud. In the current judicial and regulatory structure, it's difficult to distinguish between genuine error, a normal business decision going wrong, and a willful fraud. Dare I say, we have created an environment where honest guys are more afraid of rules, regulations, and compliance burden, and crooks are willing to take it for granted. Many a times we confuse financial degree with financial literacy. In my 3 decades in market, I have seen financial literacy being displayed by people with no financial degree and financial stupidity being displayed by people having the highest financial degree. Can a non-finance director justify position on audit committee? Undoubtedly, yes, provided he is financially literate and not afraid of asking questions. Many a times, what we need is a common sense rather than complete knowledge of law. Compliance to the law is absolutely important, but an angle brought by non-finance guy through common sense will also add value to the audit committee. Financial oversight and accountability is a fine balancing. The 3 things which any board member should focus upon: 1, truth and fairness in financial statement. While there are many accounting standards pursuing truth and fairness, ensure that the statement which you approve passes the smell test. I have seen a retail company which was engaged in selling of ready-made garments running an inventory of 1 year. This was done at cost. undoubtedly, board member should have applied common sense to figure out that a ready-made garment not sold over last 1 year will require some sort of markdown. The second thing which you should focus upon is cash flow conversion. While profits, EBITDA, they are all an opinion, cash flow is reality. Focus upon cash flow to check whether financial statements are true and fair or not. The independent director on audit committee should hold management accountable by constantly asking questions. If needed, have an independent meeting with CFO rather than entire management to get your questions and doubts resolved. When you ask questions to the CFO, to the management, from their reply, you will be able to find how sincere they are. Do they have to hide anything? Or you can take them at face value. At the end of the day, as board of directors, our job is to set boundaries, set rules, and observe that rules are followed. Do not hesitate to show a red card or a yellow card when needed. Once few yellow and red cards are shown, I can guarantee you compliance will improve significantly. Risk management is a culture. In a sense, it means let your profits run and cut your losses. Will it be possible for the management to anticipate every risk? It will never be possible for board or the management to anticipate every risk. There will be odd delivery which will bounce or skid or swing more than we can expect. What is important is that there is culture of recognizing the risk as and when it arises. There's no point in doing post-mortem. We can do that later on. The focus should be to empower management to tackle the risk then and there itself. Many a times, management believes, let's hide the risk rather than share it with the board. On its own, risk will disappear. They are worried about the scolding they may receive from the board for not anticipating that risk. That culture of expecting 100% anticipation of risk and making it hide because of fear of scolding is not good for any company. Crisis management is obviously the most important work for a board. Crises don't announce. They arrive many a times unexpectedly. Each crisis is different from the past one and yet has many learnings of the past which can be applied. As a board, we need to frame. As a board, we need framework for crisis management. It should appear with the management before rather than at the time of crisis. The role of the board should be supportive of management to manage the crisis. When the soldiers are in battle, they better focus on what is in front of them without worrying whether their back is covered or not. Of course, post every crisis, one can do post-mortem and analyze, learn, and take corrective action. During the crisis like COVID, we have seen an extended flexibility given to management really made a difference. In our own group, we were running a war room to ensure that all our staff were taken care of. If we had followed normal rules of providing monetary support, probably it would not have worked. Each senior level of manager was given discretionary power to spend well above their normal limits. Object was very clear. We have to save everyone. No one should complain lack of support. Money is secondary. Saving life is primary. Once crisis was behind, of course, those powers were taken. The audit of all the spending was done. The whole purpose of crisis management is to act as a team. The board and the managers are together in the battle. There is no blame game. Forward guidance is a tricky subject. Best of the analysts go wrong by a massive amount. The board should create a culture where forecasts should always under-promise and work should always over-deliver. This conservatism is absolutely important for good companies. Many a time management commits mistake because they don't want to be seen as a person who didn't meet the targets. Forecasting could be for internal as well as external stakeholders. The annual budget must have flexibility to meet changing scenarios. If there is an emergency like COVID, like Middle East crisis in between, the board should be considerate and willing to change the budget rather than push achievement of targets at any cost. The same thing will apply in external forecasting. Under-promise, over-deliver. Prepare and budget for the unforeseen events. And in case it gets hit, feel free to revise it downwards. Share the bad news early. Successes can be delivered later. In forecasting, the board must support management to accommodate for genuine deviations. With the advent of artificial intelligence, the shape of board meeting is going to change. The way to present information, the way to question, and the way to verify data all are going to change substantially. But do remember, when you upload data to LLM, it could be shared in public domain. You will need to use company LLMs which are secured and which does not allow sharing of data. Each board member should be trained at the company cost in usage of AI. it will be unfair to expect that every board member will be literate about AI and will be able to keep pace with the latest development. AI will take away burden from management as many of the queries, data, and communication could be sorted out through AI leverage. In 2030, I believe there will be a digital CFO and a digital company secretary along with real CFO and real company secretary. Most board members will be communicating with digital CFO to answer their questions, to run verification of data, to make comparison with peers, to test forecast. A lot of questions will get answered in this digital communication. The board meetings will focus more on human elements. Today, many a times, large part of the board, many a times, a large time is devoted to routine and compliance matters, and many a times there is shortage to discuss strategic needs. The AI leveraged boardroom will ensure that board focuses more on strategic needs rather than routine matters. One financial habit which every individual, including a board member, should develop, should retain, and should remember is risk-adjusted return. When the going is good, we all enjoy the thrill of speed, but then unforeseen risks do come. As an individual, as well as a board member, we need to remember there is no free lunch. Risks and return are two sides of a coin, and they are inseparable. The most important question which every audit committee should ask the management, and very rarely it is being asked, is there any question which we haven't asked you? Is there any information which you haven't shared in fear of rebuke from us? Please feel free to communicate and share. We will judge not based on the errors committed, but on the basis of your genuinity. It is the job of the audit committee to assure management that they feel free to share their errors and omissions without fear of reprisal.
Yeah, thank you. I guess the emphasis on intent that Mr. Nilesh Shah was articulating was indeed, there is as much emphasis one can do, but that fact cannot be overturned. Intent prevails over everything else. Yes, Kashish, with your permission, we would want to see, actually want to be looking at getting out of the panel. Kashish, back to you first. You're on mute, Kashish.
Apologies for that. Ladies and gentlemen, we had received a kind confirmation from Mr. Nilesh Shah earlier that he would deliver a live address. But because of a last minute meeting and an unavoidable one at that came up with the government of Maharashtra, he had to just be present here in spirit and share his insights via this recorded message. And as much as we would have benefited with the live session, unarguably, even this address has given us a lot to come back to and reflect upon. And before we segue into the panel discussion, let me take this opportunity to officially introduce Mr. JP. Mr. Rajangam is a seasoned finance and risk management professional with 24 plus years of global experience, including leadership roles at IODGlobal, which is world's fifth largest accounting and consulting network across India and the UK, where he became one of the youngest partners. He has advised on cross-border transactions exceeding USD 2 billion, spanning M&A, restructuring, and virtual CFO services. He has been a visiting faculty at SP Jain Global Business School, Australia, and MIMS India, and a Masterclass-for-directors faculty at IOD. And he's also the author of A Handbook of Financial Management, published by the Institute of Directors, India. Over to you, Mr. JP. And with your kind introduction, I think we're all ready for the panel session. But
Thank you, sir.
Right. I would also like for you to allow me to introduce to our audience, before we actually benefit from their insights, the panelists that we have, the distinguished panelists that we have with us today. Our first, I hope I'm audible.
You are.
Our first panelist is Ms. Sushmita Ghatak. Ms. Ghatak is an independent director on several boards and former MD and CEO, ICRA Analytics. With over 31 years of experience, she has built a distinguished career spanning corporate governance, strategy, business leadership, and organizational transformation across Tata Steel and the ICRA Group. After beginning her career with Tata Steel in 1993, she joined ICRA in 2000 and played a pivotal role in building and scaling its consulting and outsourcing businesses. She subsequently served as Executive Director and COO, and later as MD and CEO of ICRA Analytics, leading the organization for nearly a decade. Ms. Ghatak currently serves as an independent director at Anudeep Foundation. Our second panelist is Ms. Aarti Porwal, Senior Country Head, India at CFA Institute. Ms. Porwal is responsible for designing and implementing CFA Institute strategy in India, with managing its enterprise resourcing in the country. She joined CFA Institute in 2015 and led the society relations function for India and surrounding markets before taking over as the country head. Prior to that, she was the senior market advisor at Enterprise Ireland, providing advisory services to Irish enterprises on market entry into India. Ma'am also led the Chartered Institute of Management Accountants in India for 5 years. And lastly, we have with us Dr. Abhishek Agrawal, Managing Partner, Axiom Digital Transformation Fund, which is a global fund investing in emerging markets in financial services companies and supporting them in digital transformation. A chartered accountant, MBA in finance, and a PhD in municipal financial reforms, Dr. Agrawal comes with extensive experience in investment, portfolio management, strategy, and business planning. He had worked in various roles in the financial services sector across the globe and now leads the fund as an investor. He is on several boards of financial services institutions and companies. And with that, over to you, sir.
Thank you, Kashish. And it's really an honor for me to be in presence of three people with varied experiences. For all the participants, what I would surely want to draw out, one of the key elements of this panel is we have Sushmita, who comes from an operations CEO role onto a board role. We have Abhishek, who comes from CFO onwards to a board role. And we have Aarti, who sets standards for most of all of this through her standard setting exercise. And so we have a combination of people on this panel who can bring different perspectives. And I'm sure each participant in this, in this larger forum will gain out of these different perspectives. With that, having said that, I would surely first, in the not in the order of alphabetical order as it generally goes, but generally out of the more logical way of inference, where a lot of Nilesh Shah's address earlier was focused on setting expectations of how board should view operational team. So I would take the lead by asking Sushmita to speak about her own transition from a CEO to a board member, and what could that be one thing that as a board member now she looks at, which as CEO she never found her board to look at. So, it would be a good way to start building on what Nilesh and earlier Mr. Thakur also spoke about how board should look at operating team. Sushmita, please.
Sure, thanks. So one thing that kind of changes when you move from a CXO to an IT position is, as a CXO, you have access to a full spectrum of information. It is there in the ERP, it is there with your colleagues. You are kind of, creating events, you are participating in events, you are witnessing events. So all information is there with you real time. And therefore, you are kind of well equipped to take decisions. The moment you move to a board position, the information comes to you at predetermined times. It's not scanty. It's kind of pretty voluminous, and they are kind of, because it's on different committees, it's like spread across different places. Now, and it need not necessarily be in an analytical kind of format. So I go back to kind of, what the other two speakers spoke about. It's like looking at the story behind the numbers. And let me illustrate that with an example. So supposing you are on an investment committee and the management has come to you with a proposal for a product development expenditure. Now, being a financial literate director does not mean that we will get lost in calculating the IRR, NPV, etc., which of course needs to be done, or look at the amortization policy. Those will be seen by kind of, the audit committee, others. But as somebody on the NRC, I would see that is the HR budget congruent with the kind of manpower that I require to do that product. If I have spoken about, just an example, 10 Python programmers. So do I kind of see that skill set when they are coming to me for my approval of the HR budget? If I am on the technology committee, I shall see that are the systems kind of, getting upgraded to handle the additional volume that should possibly come out of this particular SaaS product or something. So this whole point is that we would need to sift through data, and we would need to get the building blocks together. So JP, the answer to your question is in two forms. One is, as a CXO, maybe the information came to me neatly packaged. Here it also comes to me packaged, but it is in different pockets. I need to collect it from there, point number one. Point number two, as a CEO, a lot of my time and everybody else's time, I would think, goes in explaining performance and how would the next quarter look or the next year look. As an IT, I need to go back to the first principle that an IT is either appointed by the shareholders or by the regulators. So it is in terms of the long-term approach, ensuring that the risks are covered. So those two would be the predominant differences, the data and the perspective that I kind of, put onto the data. Back to you, JP.
Appreciate, Sushmita. On a lighter note, if I may pick it from there, that intelligent CFO who wants to guide the IDs into whatever domain will densely pack up information and the IDs get lost. So here we'll bring in Abhishek, and I'll pose that question to Abhishek. How, you've obviously been on the CFO side, but now you're on the investment side, you're on the ID side. How do you, as a board member, ID more specifically, independent director more specifically, would you cut through all these dense information which are in very intelligent CXO team could present to you and get to the nub? What are the key elements based on your experience as CFO and also as board member that you would articulate?
No, thank you very much, JP. This is a great question. First of all, let me confess the transition from a CFO to an ID or a director was not an easy one. As I think Susmita highlighted, as a CFO or as a CXO, you have access to so much of information. And if you're good in reading the story behind, I really liked what Gautam gave us the takeaway to all of us, that if you are good in reading the numbers, if you're good in reading the pattern recognition, that where is this leading to, whether it is on the sales side, whether it is on the client engagement side, or whether it is towards the financial performance side. The story has to stitch together. I think I found that once I was the board member, I would tend to get into far more detailed informations and reviews with them because I had this previous background of being the CFO. Having said that, I think today, as I look at it, it's very, very important for the IDs as well as the directors to really understand the business nuances. I think often as we go as a director on the companies, we aren't spending enough time in meeting the employees, in understanding what exactly are we doing. It's very because at the governance level, we have three things to manage. These are the three key pillars of any company: clients, employees, and your shareholder. At the governance committee level, you are trying to make sure that you are able to take care of the representation of all three of them, whether you are coming as a director or as an independent director. So it becomes very critically important for one person, for the director to get into the business. I don't mean to say nuances, but really understand what are you doing, who are you serving, what is it into. And then once you have understood, and this is a principle which I have always adopted at my level, I always make sure that I make a field visit once every year, if not more than that. And that just gives me the perspective when you are able to talk to your client, when you are able to meet to your lower staff, who is doing the services for you at the ground level. And then you start to read the numbers. And by the way, I must say again, reading the numbers in today's environment is not easy. I think all these INDS, IFRS, provisionings, and some of those have made it far more complex. So in order to make it simple for you to understand, my take is you have to understand the nuances of the business. And once you have that, once you start to look at those numbers sitting into the room, I think a story starts to come out together for you. The last one I would say, when you ask me this specific question, how and what the advice on some of these numbers looking, you shouldn't be getting lost only in the financial performance numbers. As you look at the financial performance numbers, I think there is a story behind these operational numbers also. Once you bring these two together, and often there is an overload of information which comes from the management team, but if you keep a focus on operational and the financial numbers, I think the story would come out to you naturally from that conversations. JP.
Appreciate, Abhishek, and can't disagree more. Yes, Mr. Thakur would have been happy to get reiteration that a chemical engineer or the operations always prevails over, or the story prevails over the numbers, which logically then gets me into a question for Aarti, that if here the question is largely that is it a question of skill or is it a question of mindset? When we hear Thakur or Mr. Thakur or Abhishek, they are saying it's about the mindset that you bring on the table when you are evaluating numbers or looking at financials. Whereas if you start looking at it, most of what is prescribed by standard setting body like CFA or like our own institute where I belong, I'm a proud chartered accountant, there are standards prescribed. So based on your own experiences, discussions in multiple forums, what do you think? Is it today more a question of skill gap, or is it a mindset gap which makes today's board more relevant, more effective, or more up for the task?
Thank you for that question, JP, and for the opportunity to be on this panel. I think I'll pick up something from what Sushmita said. She said that it's a question of having the oversight and perspective, which is different from being in the management team versus being on the board. So instead of skills and mindset, I would look at it as the fact that the role of board members is evolving rapidly. In the past, when they could probably rely more on the management to provide them with the necessary information, and the role of the board was limited to some level of oversight. That's changing both with regulation as well as with expectations from investors, to a point where the board not only provides oversight, but is actually responsible to provide vision, to provide strategy, and also to ensure that the levels of governance and integrity within the organization are well managed and maintained. Most of this requires a confluence of understanding of not just strategy and finance, but also of operations, and also mainly an understanding of the clear value that the organization delivers, an alignment with that, and alignment with the ethics and integrity required for organizations to remain sustainable and to exist. All these factors come with a need for board members not only to be educated and knowledgeable, but also to have aligned value systems and a long-term vision. So both skill and mindset as well as characteristics need to be aligned for a board member to be on a particular board. So I would say we cannot narrow it down. It's more like a question of building a marriage or partnership wherein all these aspects come together. So I would say that it's across all these parameters instead of looking at it just as a skill versus mindset issue that we need to consider.
Fair point, Aarti, and I borrow that. Leading from that, if I may say so, a lot of what happens generally in the regulated world out there, and the whole corporate system is based on certain regulations coming from different angle. From a CFA Institute perspective, I have to ask that there is, obviously you guys are doing something on the Atal Innovation Mission on financial literacy, but that's more on the startup focus on startups, focus more on the grassroots school ecosystem. Is there similar conversations happening for what could be prescribed for a board, or is there some kind of such larger conversation for standards or for directions for what should happen on board, which was again emphasized by Mr. Thakur and Mr. Nilesh also, that itself that it motivates. But is there some regulatory view that is emerging there, or is there CF Institute in any manner working on such standards?
So the CFA Institute's work with Atal Innovation Mission is driven by the fundamental belief that we own, and so an Atal Innovation Mission and the government supports that any idea or organization can only sustain if there is a strong foundational level built of both financial governance and governance in general. So financial literacy and governance are basically the fundamental pillars for an organization to sustain and to grow. Why we are working with them at the startup level is because the earlier you build these foundations into an organization, the better potential for it to succeed and grow. If you look at the startup ecosystem, which is rapidly growing in India, there have been some significant successes with the unicorns, but there have also been multiple failures. And if you examine the failures, most of the failures did not happen because the startup was built on a bad idea. Failures happened because of lack of financial acumen or lack of governance structures in the startup, especially when it was reaching a point where scalability was being built in. Governance also faces challenges at points when there is investment transition from one investor to another, especially as we see many of these startups have private markets related investments, and therefore there is probably potentially a conflict between the objectives of the various investors or people even on the board, which could spill into the board. So therefore, it's essential that at the startup level itself, we build in these foundations of governance, financial acumen, ethics, and integrity, which all are very much a part of everything that CFA Institute stands for and does. So in terms of our curriculum, whether it is our foundational certificate, the investment foundation certificate, or whether it is the CFA program, the understanding and the learning outcomes are based on delivering these skills. That is the ability to understand numbers, to read numbers, to be able to build a picture of it or from it, of what will happen not just in the next week, month, or year, but also 3 years from now, which helps to actually direct or provide inputs to strategy. And it has we have all our charter holders, candidates have to abide by our code of conduct, which is, and ethics is very much a part of our curriculum. So we establish the foundational knowledge of ethical behavior, integrity, and the fact that it makes business sense. But at the same time, when it comes to codes and standards, CFA Institute has works with the investment management industry. And as I mentioned, the investment management industry and investors drive objectives of the board, the leadership, and the organization. So what we have is codes and standards for investment managers that help them in making ethical decisions and putting client interest first. And that helps them as members of the board and supports them as members of the board in making decisions that are grounded in these fundamental pillars.
Interesting. So I do pick up that the we are focused on investment management to be able to, or we are enabling investment managers. So if I have to take that string up and say, Abhishek, if I have to put that question slightly different to you, as to you are on microfinance companies, boards, you are in various, which have impact across multiple stakeholders. You did mention earlier about employees, stakeholders, and even the management board. One way or other, you're looking at all the roles. So if I have to ask that question, the moment you get into financial services or where there are larger stakeholders from the society who come into play, how would you sharpen the bar, or what would your idea be different? Because today we are looking at multiple scams, which is impacting larger set of society members. What is that thing that you will be very conscious about for financial oversight to sharpen your focus that these things don't happen in the board that you are in?
No, thank you very much, JP, for that interesting question. And this is in our DNA. When I say our DNA, we as Axion have been in this space for the last 65 years. And what we do is really social impact investments. Social impact investment with the lens of private equity as well as venture capital. Now, as a part of investment, our philosophy is also to ensure that in the companies where we go, we are able to make them as the standards or as the leaders of the market, and in which governance plays a very, very critical role. And before I answer your question, I would like to go back to what Aarti was just mentioning. I think from a startup world, given I mentioned that we invest into as a venture capitalist as well as a private equity. Venture capitalists, our tickets are very small. Our tickets can be $500,000 to $1 million of investment. Now, our biggest challenge, and we screen almost 50 to 60 companies just in India. Globally, we screen more than 300 companies every year. And then out of those 300 companies, we are able to make investments in the early stage ecosystem in 10 to 15. The biggest challenge we see in the invested as well as the screened companies is what Aarti highlighted, governance. The founders in those early stage built up ecosystem do not have enough insights that what really need to be put in place. Everybody is getting driven towards the idea, towards the prototype, or towards the valuation side of the story, which is equally important. But as you attract the investors, particularly the savvy investors, which are getting trained at the CFA Institute, these investors starts to look far more deeper there. And that's where I think governance becomes a big critical issue. We as Axion, again, have been doing our own bits and pieces. Given we are a global player, we go in different markets and see how we can bring the knowledge and learnings, either through the Harvard programs or through running our own governance workshops in these specific markets. India is fairly evolved, so I think our role is more there in the Africa and other regions. In India, we have the institutions like IODs and others who can conduct these. But I think in the global level, we see this challenge very, very differently, even in the evolved institutions as well. So forget the startup ecosystem, but even in the evolved industry also, there is a big challenge on the governance, related party transactions and the influence and so on and so forth, where our regulators have played a very heavy role, sometimes with a heavy hand approach, given the cases being involved, and sometimes with the nudges and the reminders and so on and so forth. Now then, coming to your specific question on financial services industry, I think given our work, since we come with the impact lens, we work with the underserved, unserved community. These are rural borrowers. Largely, in our case, these are women borrowers, which could be highly illiterate. And in that sense, I think one of the big responsibility we take in working with the management and the founders is to ensure that the customers should not be taken for a ride, which is where we come and ensure that, and we run the specific mandate on client protection principles. These are, in a way, self-imposed principles, I think, which Gautam talked about, Nilesh also mentioned about, that how can we institutionalize the self-imposed principles so that your clients are not going to be taken for a ride from the low rank of officers all the way to the board level. And as you institutionalize some of these things, I think you start to work across these stakeholders in ensuring whether you are setting up your pricing guidelines on a product, or you are setting up your recovery guidelines from a collection practices perspective, or you are working with these customers on the newer avatars, these digital avatars. How do you ensure keeping that customer in mind? And I think what is most important is in that boardroom that the management also equally spends enough time in ensuring and educating, because not everybody will come with the same level of understanding, that you ensure enough time either in the board meeting or in the pre-board meetings to ensure that you have been able to bring everybody to the same level. And then the last, I would say, given you asked me how do you sharpen the board, I would say even the board member also need to often open the material which comes from the management companies and then start asking the right questions.
Interesting. I hear you that a lot of the numbers, while the question we generally would be taken by most of the participants as, is there an indicator? Because when I heard Mr. Nilesh Shah, he said cash flow is a reality, whereas EBITDAs are interpretations or opinions. So most of us associate financial governance with one of these numbers, whereas you took a step back while explaining that it's not primarily that number, but a larger thing that you should look at, the larger narrative from different angles on different business models. So I would want here to bring in Sushmita with her background in ICRA for sure, and her experience with a wide range of companies that we have heard about ILFS, DHFL, Yes Bank, the latest being Rajesh Exports from a different angle entering into that conversation, Reliance Capital for various reasons also. So they all had effective audit committees. They all had all that one could ask for systems to work perfectly. So financial literacy might not be an issue surely for there. So was it an information failure according to you? Was it a culture problem? Or what was your view when you start looking at these distinctive failures specifically on financial governance by the boards, which otherwise looked very enamoring, very overwhelming?
Sure. Before answering your question, I'll take you to Gensol and the famous company that failed somewhere in February 25. Now, if you look at it, two things stand out. One is on EPFO and GST, they were kind of, not depositing them on time. Now that's an early signal, an early warning signal that if we had looked at compliances, kind of, that is one, they were also not making their payments to their lenders, etc. And this is where the question, and there was also this letter that was written by their ID when he resigned. He said that there were certain things that were bothering me, and I reached out to the CFO for a time with the promoter, but I somehow never got that time with the promoter, and I somehow never asked you that question. Now, for me, that is possibly the most telling. And this gentleman is kind of, very erudite in terms of all the qualifications that one could look at. So when you are sitting in a board, which either has a promoter who is either larger than life, or you have a chairperson or an owner who is kind of built up the business from, from the very beginning, there is a culture. So it's not a question of the information not being there. Maybe we did not ask for it, but that information certainly was there. But what is the culture? Does it kind of reward, and not reward in monetary terms, but more in terms of, how am I looked at if I ask uncomfortable questions, if I challenge the assumptions? So those were probably kind of, they are not done enough. So there are enough storied boards. I mean, if I look at the Satyam board, if I go back to 2010, I mean, was that board kind of, any less than what one could have, thought of? Or there are multiple examples that one could talk about. So yes, maybe at times, maybe some information was not given, but again, if we had asked for that information, it would have come in. But possibly it's also maybe the Indian culture where we tend not to kind of ask too many difficult questions. And but at a board, in a family, it's maybe all right or may not be all right, a separate conversation. But at a board level, asking the right questions and kind of, also noting the dissent if it is required, if the answer is not kind of, so as an IT, as a board member, whatever, and I think Nilesh spoke about the common sense. So at times, I mean, not an early warning signal, but supposing you are on the board of a lender and he says that my asset has really kind of, my book has really grown. One of the questions is, to whom are you lending to? Are you lending to companies that are very prone to climate risk? Are they kind of, and tomorrow would I kind of have NPAs? So these are also some questions. So one is, yes, wonderful that I have kind of, lent to more people, or have I lent to people whose scores are kind of, not very good kind of CIBIL scores? So one is kind of, challenging the assumptions, asking questions that are relevant. And even if one is an outlier, if I may use the term, in that group, so the entire group might be thinking in one particular way. But if your internal judgment, your interpretation of the business wants you to ask something that might seem contrarian, we should go ahead and ask it. Maybe the others haven't thought of it, and there is no harm in asking something and getting the doubt cleared. So JP, to answer, it is more the culture in terms of not asking difficult questions or challenging the assumptions that might have, and this larger than life figures that are there of certain promoters, certain chairperson, where we think कि उनको तो सब पता होगा, और मेरे आसपास जो बैठे हैं, they are also kind of, very famous and very good at their work. So if it has passed them, it must be all right. But we need to do our due diligence ourselves. Back to you, JP.
Appreciate Sushmita. Yes, indeed. Larger than life is one of the key elements that we would find through most of the examples that often are quoted. Appreciate that. This brings, if I'm on the board, obviously, when I start looking at the conversation from board members' perspective, this brings me to the question that I am independent on the board. Whom am I representing? Technically, no one. It's a retail shareholder, or I'm looking at larger general society per se. But fundamentally, when a business is running, it has conflicts between what a shareholder expects, which is maximization of profits, to what an employee expects, which is maximization of his or her remuneration, to a government which wants compliances and tax payouts of the highest level, or to the most optimal level. So we have these pulls and pushes, or a customer wanting the best service, or a vendor wanting money upfront. So all of these are multiple conflicts. And if I'm on the board of a company, what are how do I play out, or how do I evolve this financial conflicts within an organization? So what would be my primary guidance to my operating team? Should stakeholders, wealth creation be primary? Should employees be primary? How would we go about giving guidances? Because culture, as you said, most of you have agreed, culture is the central principle. So what would be board's guiding principle, whichever board you are in, or what would be a general feedback? I'll pose it through Abhishek first, and then I'll move it to others, the same question to others through as we move ahead. So yeah, Abhishek, starting with you, we can move the same question. How do you emphasize on culture when there are conflicts between various players in a given entity?
Yeah. No, thank you very much, JP. I think being the board member, you often get to see the conflicts. And that's why you are there as a board member, how you resolve them, how you work with them. So that, and again, that's not easy. But having said that, I think there is also a reason why the independent directors are being appointed in the company, so that they are going to take care the interest of the company first. And when I say company, this means that they will have to take a holistic view. And holistic view means it's a shareholder's wealth creation. It's the social aspects of the company, which is employees' well-being, their remunerations and other things, as well as the clients, and the larger purpose of that, how this company can continue to sustain. Now, in the mix of listed companies versus the unlisted world, and as you see it out there, there is a greater emphasis being put out on the roles and responsibilities of the independent directors, because they are the ones who are being assumed to be that they will take care of the unbiased view towards the company, versus a nominee director, either on behalf of the promoters or on behalf of the investors. Often in my conduct or as the boards I sit on, I have seen that people people continue to play along in the larger interest of the companies. But this is a key responsibility which has been, I think, embodied towards the independent directors. And over there, I think, as you pose this question, the biggest would be that when you are looking at it, and I can't recall who mentioned this in the address earlier. Was it Manoj, or was it Gautam? The view of how do you have a long-term view on anything, any decision coming to you, whether it is a 20% increment being done today on the NRC or on the board for your management team because the performance has been fantastic, or you thinking about that if I do a 20% increment today, can this sustain this organization in 5 years from now? If I keep on giving 20% increment, I'm going to create that impression that, okay, every year we will be able to get these numbers. So I think, as the independent director, the job is very, very difficult. And that's where I think you will have to keep this view that how do I make sure that my vision here is long-term in the best interest of the company. And sometimes I might not be pleasing the parties there, and that's not why I am there for. I have been appointed for a larger objective. And Susmita mentioned, do not get intimidated. I will use this word. Do not get intimidated by some of the people who are larger than life in those conversations. I think you are there to make a point. Regulators have been time and coming again that if you do not agree on certain things, it's very, very important, rather than being silent, you make your point on those.
True. Get intimidation, a lack of that, being intimidated is very central to being independent for sure. Aarti, your view on this same matter as to the conflicts, what should prevail, or how would one as a director look at this? Primarily on finance decision, because without employees being paid higher remuneration, which is today, I see most of my clients in Bangalore, or most of the tech world, they have to pay through their nose to be able to just get the right talent and retain them. And this could be at the cost of the continuation of the company, because cash flows get drained out just to pay the remuneration or to afford otherwise a technically competent team. So what would be your suggestion or thoughts on this conflicts between various stakeholders?
First thing I would say is that conflict is not a bad thing. The reason why a board is a collective group of people, which is supposed to make collective decisions, is because we want to bring in different opinions and ideas into the decision-making process. In fact, that's why it is essential that board diversity is maintained. Board diversity makes business sense. The diversity should not be just in terms of gender, but also in terms of diverse perspectives. So that people come in with different sets of experience, knowledge, and perspectives. And the decisions are made while taking into account these diverse perspectives. That helps to ensure that the decision is robust. And that's why whatever decisions the board take, it has to be a collective decision and considering all these perspectives. The second is, one way I would say that conflict can actually help to collaborate is if all other things remaining unequal. There are two things that should remain common. First is the focus on sustainability of the business. Sustainability does not mean in terms of environment or social impact. It means the business should sustain, it should remain. Jaan hai to jahan hai. So that means only if the business exists will it achieve its objectives. So the board's understanding that we are all working towards this collective goal of sustainability, which will of course lead to growth, lead to shareholder value, etc., will ensure that the decisions finally converge to that common goal. The second thing is the grounding in integrity and ethics. I might be sounding like somebody who keeps repeating the same thing, but the truth is that if that fundamental grounding and alignment is there with integrity and ethics, everything else will fall into place. So that commonality of vision or goal ensures that conflicts actually help to collaborate and come up with common decisions that helps everybody. I would just say that.
Nicely put. Conflict, trending towards collaboration. So lovely, nicely put. I would then surely want Sushmita also to weigh in on this particular element, and given her experiences in different domains, and she would have seen that for sure playing out in multiple different boards, which should have analyzed in the analytics in her earlier avatar. So, Sushmita, please.
Yeah. No, I grew up in Jamshedpur, and my first job was at Tata Steel. And Tata Steel is a textbook case of how to kind of, manage conflicts and ensure the expectation of everybody, and kind of, borrowing from Aarti, be a sustainable kind of corporation. 2 points here, JP. You have this business roundtable, a collection of US CEOs who in 2019 spoke about that the goal of the organization is to kind of maximize all stakeholders, not shareholders alone. So we are looking at a kind of a very cohesive approach. And the proof of the pudding is, where does capital go to? So where does a mutual fund kind of investor invest? I'm talking about the fund managers. When they look at companies, how do they choose companies to invest? So earlier it used to be financial prudence. You looked at good credit ratings. Today, along with that, you're looking at ESG ratings. And that again gets us back to Aarti, that we are not kind of, we are looking at a very composite kind of growth where they are not, they will be in tandem. The environment will be in tandem with social, which will be in tandem with governance. And only that will ensure kind of, sustainability. So for a short term, there might be an issue. The point you made that, if I pay higher salary this year, my EBITDA for this year might come down. But if I'm creating a successful product by kind of hiring top-notch people, that product will kind of, help my customer get better service over time, will help me get better revenue. So the short answer is, it is kind of the non-financial matrices, the interplay between all of this today, which capital, any of the fund managers, they take it as a barometer in terms of where to invest money. And that is where we see this entire market of ESG rating kind of exploding so explosively, where it is not only your not just one linear figure. If I go back to our earlier 1960s, where we were told that it's only the maximization of profit that is important, but today it is the maximization and the optimization of all these goals, JP, that will attract customers, it will attract capital, it will attract your Gen Z employees. Today your Gen Z employees don't want to work in companies that are very kind of, have oppressive kind of strategies, for want of a better word. So that would be my answer, that conflict is good, but over time, the conflict kind of sorts out and you come to an equilibrium.
So true. Like the next generation is surely socially conscious. I can vote. I have 2 votaries at home who really pay for my blood every day out. That also then brings me to the next. For me, it's a more personally interesting question too. At every point in time, we have heard these interesting terms emerging. So there was eyeballs in early 2000s when the internet was just coming up. Then there was this clicks which came later on. So there were such kind of acronyms which keep on coming, which for me as a finance practitioner always becomes an issue. So in this current times where AI has taken over, I would surely want each one of you to share acronym. And I obviously started Abhishek at this point in time, given that he's an investor also. So what are the AI related acronyms that you are currently hearing, and your view on those acronyms? There was this, as I said, eyeball, clicks per dollar, and all of this were coming up at some point. There was also this so-called gross revenues, which had nothing to do with actual revenues. So what is the current trend of these terminologies, and what should we be mindful of?
Thank you very much, JP. I think, could not have agreed more with you in terms of, I still remember when we were evaluating some of these investments and we were being explained about the GTM, and which is nothing else but the gross revenues where you have booked up everything. And the other day, somebody was giving me an example that, the cars are going through the tolls, and now the toll operator is saying that all these cars belong to me because they have passed through my toll even. So in a similar analogy, I think, how the GTMs and others were being taken. And I think this industry has been shaping and changing so much, where you keep on hearing. In fact, yesterday only when I was at a board, I had to tell the team that please, when you are coining out these acronyms, please put their full forms, because I'm not the fancy ones. I might.
He get intimidated by those acronyms.
He put the word tofu, TOFU. And I said, I like tofu to eat, but this is not the context why you are using it here. So I think, again, given that we come from the financial services industry, in our industry, what has been important, particularly from the fintech lens and the question you asked me from an AI part of it, I think our focus continues to be one from a growth scale. And within that, I think the new lingo, which we all have been now more and more focusing, particularly in last 2 years, is the CAC. Again, CAC is not a new word, cost of acquisition of your customer. It's not a new word, but back in the day, everybody was just being driven by the growth. That what growth you can reach, how many customers you can reach out, how many downloads you can have. But today, I think we all are analyzing what is the CAC being invested by you versus what is the revenue potential from that customer. And and what we realize often, given you do not have the longevity with the customer in this newer avatar, often you are only burning the money rather than having any visibility to have the revenues from that customer. So nutshell, to summarize it, quite a lot of focus on CAC, which really drives the conversation for us in these companies or in these investment discussions, to look at it, that what are your growth drivers? How are you going to look at it? Is it pure marketing driven spend, where you keep on saying, let me dump this data and let me see if I can have 1%, 1.5 or 2% conversion out of these just data driven calls or other things, versus from there having really a focused approach, so that this money which is being put out there is being used efficiently and effectively. And we see the bottom lines being converted into positive rather than these being in reds.
Hear you. CAC is what I would surely take it. Aarti, what is that you're hearing a lot and that you would want the CFA Institute now to put that as part of what you would want to render as ideas back in the marketplace, that we will have to obviously surely master in some time?
I think there are some buzzwords I would like that board and the investors should focus on, especially as you mentioned, with considering the context of artificial intelligence coming into the world, as you mentioned. First one I would suggest is capital allocation. Because a number of organizations are allocating capital towards AI-based improvements or changes. It is important that as members of the board who are focused on long-term sustainability and growth, that board members look at whether such capital allocation is justified with the business, and whether it actually is driving business goals or achievements, long-term achievement of the goals of the organization. The second buzzword I would say is that we need to take into account when we look at AI is data clarity, and the dependency of data, whether it is actually something that we can depend on. If AI helps to establish some level of data clarity, because it helps to convert data into information very easily. But if most of the data is driven from AI or derived from AI, the potential dependability on that data is circumscribed. So what we are trying to ensure with our curriculum also is to teach research analysts and CFA charter holders and the investment management industry the perspective about how to utilize data without reducing the clarity and authenticity of that data or the information that is derived from it. The third is, of course, data confidentiality and data privacy, both of which are impacted by AI. Data confidentiality, if you are, especially you need to beware if your board members are using AI to actually read board papers, that they have a proper, authentic, confidential access to AI for doing that. And any data or information is therefore is presented with guardrails so that it is guarded from leakages through artificial intelligence. Second is data privacy, because that is one area where AI is making interventions which may actually lead to potential legal conflicts. So most of, I would say, the issues, especially organizations are going to face in the future with respect to legal disputes and conflicts will arise from data privacy or injunctions into data privacy because of artificial intelligence. So these are areas that I believe should become buzzwords, especially when it comes to board decision making and board function.
Appreciate that. And the term that I often hear with AI is hallucination, as if AI is a real life person and it hallucinates and we are supposed to look at it. Yes, Vishwita, closing thoughts on this buzzwords, and then we're obviously getting questions from the participants, and we surely want to pick it up because that's the central. Try and build a larger idea base amongst all of us. Sushmita.
No, so today I shall not add to your dictionary, but I shall but I shall say that as a director, what keep hearing that we've implemented AI models. So what is it that we need to be careful of is my point, and it is what are the assumptions that have gone into the AI model, and what is the validation of that model. So along with the buzzwords in terms of the assumption and the validation, those two, along with just the generation and the creation, so the assumptions and the validation, those are important things that we should be mindful of.
No, appreciate that, Sushmita. I will, with that, possibly take up few questions. We are past the scheduled time. Appreciate all participants continuing and appreciate the panel continuing. I'm conscious that some panel members will have to have their other hard stops. So we'll take a couple of questions and then wrap it up with permission of all those in the panel. Yeah. I will, in the order that it came, I will just pick up the first question, which say Rahul Fadke mentions to ensure comprehensive risk management alongside our financial audits. I would value your insights on a readiness across 4 key areas. So he's articulating 4 areas around talent audits, personality. So it's more oriented to building organization. Can I lead that question to Shushmita, given that from a CEO angle, she has looked at all of this in multiple ways? So the question is, would there be dedicated role to only look at talent within the board constitution? Or would you look at operational team handling most of this and board playing a limited role on these matters? Sushmita, your views?
No, he's identified very, very important parts, and these would typically be part of the remit of the NRC, and which would typically be then done by the CHRO. That's how it would kind of, be driven. And most companies may not, apart from the very large companies, may not necessarily have in-house capability to execute these. And you typically then draw upon external expertise like, different consultants to do it. So how do you see us best aligning this to protect and strengthen the business? I mean, very clearly, when we talk about sustainability, along with a business pipeline, if the talent pipeline is not there, then the business will not be able to kind of, exist in a vacuum. Back to you, JP.
Appreciate that, Sushmita. The next question that is up there is obviously what most of us like, favorite punching bags at every point in time. So now Rajesh Exports is a favorite punching bag for anyone who wants to speak about financial scam. So your 2 cents, Abhishek, on the Rajesh Exports scam, and did the auditors fail? Did the whole system fail despite everything supposedly in place? So your 2 cents on what could have been different with the board of Rajesh Export or similar things that we are in. Today, Rajesh Export is obviously the marquee example.
Yeah. No, I think this example which I was mentioning, that every car being counted from the toll operator, it came in the context of Rajesh Exports only. So I hope that just gives the impression that this is a serious problem. And I think, again, when things fail, I think Sushmita talked about it, some of the examples from the Satyams and others. When some of these things happens, it's very easy to start pointing the fingers that, oh, this failed or that failed or this did not perform. But this is a systemic failure, really. In spite of we having the great regulators, in spite of we having the adequate knowledge, the great
audit firms, why are we failing time and again, particularly when there is a public money being involved? Is it that all of us aren't paying enough attention to the numbers, what gets presented, to the story, what is coming out of here? And I think, the bigger problem I see as I sit across in some of these companies, when the story is going good, nobody pays attention because you believe in that what is being presented, you all clap and you go happy. But it's only the challenge when you start to see something tricky and something balloons starts to burst, then the people start to run around and look for the cover. So my thing is really, I think in light of that question, it's very, very important and critical, given we have taken those board roles and those positions, that we become responsive and responsible and start paying attention to what's really going through our nose and questioning some of these things. It's not one person's responsibility, I would say. Audit committee looks at what the auditors are presenting. You can always question whether there is sufficient information being provided. Do you suspect anything else going on? So I think rooms are enough there to question, but often these questions are not being asked enough. And over there, we need to put enough guardrails in place so that at the end of the day, consumer or the investors, particularly small investors, are protected and are not taken for some of these systematic failures.
Appreciate, Abhishek. And here I would possibly repeat what Manoj mentioned, the opening remark. It is about not compliance, but about competence. And it's not procedural, but purposeful board. That is what Manoj had mentioned in his opening remarks. So I would defer back to that point, which is what all of us are in one or other way articulating. Here, I would take, possibly given the time, possibly Aarti, the last question directly, fairly and squarely falls into your domain here. As to, most of us would always hear this, and I'm not a finance person. What is that I should look as numbers specifically that will give me some idea is that things are in right angle or not? So, Aarti would give you a quick couple of indicators that you believe a non-financial person can broadly look at and get some comfort or some ideas.
I think some of the things were mentioned by Sushmita at the very beginning. Data points really that may not be even in the financial statements, but the board should be asking for it, looking at it as early warning signals if things are not going right. Standard parameters for seeing how things are going good, as Abhishek mentioned, are available. But as he pointed out, what we need to look at is when things are going right, be more careful and be more watchful of what could go wrong. There's no point in bolting the doors when the horses have run. So if we are looking at early warning signals, I think a lot of non-financial data does make sense to look at. And the board should ask those questions, especially those related, I would say, to people. And most of the signals are there, like, for example, employee retention. That is something that gives a very quick, very early warning signal in terms of if the retention rates are affected. Customer NPS and customer satisfaction levels. Again, data that clearly points out towards whether the business resilience in terms of customer acceptance remains and satisfaction remains. I think so. Looking beyond financial numbers is actually what I would say I would encourage people to do, and look at that customer perception, employee stakeholder perception, data of litigations that the organization is facing, and what is the challenges that it's facing in terms of litigation. One of the things that we have been doing, which can be useful, especially on the sustainability field, is actually interpreting reported data, like, for example, BRSR data. It's a great initiative in terms of reporting from the government. But we're trying to make that a part of ethical and investment decision making by actually producing an annual report which looks at the BRSR data submitted by the top 300 companies and analyzes it in terms of whether there have been any improvements or changes in terms of those data points. So that is it. We also publish a Mind the Gender Gap report, which is based again on BRSR submissions, which looks at organizations and whether they have made any improvements in terms of gender parity, pay parity, and gender inclusion. So I would say that there is sufficient amount of amazing data available there. But what's important is that data translating into relevant information, and is there sufficient analysis being conducted to actually measure year-on-year performance? And I think some of these parameters, especially gender diversity and sustainability related parameters that are within BRSR and which are being analyzed, actually give you early warning signal as well as provide light at the end of the tunnel, or otherwise to give direction to decision making.
Appreciate it. Thanks so much. As a closing, I am conscious that we are running out of time. I would just pose one quick question to each one of panel separately, and I would request if you can respond whatever comes to the top of your mind. One is for starting with Sushmita, that she started off the whole conversation. If I have to ask you to rate from 1 to 10, the current the range of boards that you have seen in various contexts, in various roles that you have played, what would be your rating? 1 being the least and 10 being the maximum. For all the companies that you have seen, listed, unlisted, what would be your view if you have to rate all the boards that you have seen from 1 to 10?
On the financial literacy parameter?
Yes.
Okay. So the ones that are listed, and especially their audit committees, would be pretty high at about 9 or so. But if I were to look at an average, and not and the other committees need not necessarily have such kind of financially literate, so it would be somewhere between 6.5 to 7 is what I would say.
So picking from that, Sushmita, thanks for the Sushmita. Abhishek, what is that one thing that you would want board members on the finance side truly to know or always be on top, which will take Sushmita's rating from that 6.5 to 9 for everyone? What would be your view?
Sorry, I think I mentioned this in the beginning when you posed me the first question. The board members would need to look at these two numbers together, the financial performance combined with the operational performance. And I think often, and again, board has to be a very diverse room, and this is good that if you have the diversity in the room so that all the views can come together. Often I have seen that people are not looking at these two numbers together. So my one thing would be start looking at your numbers when you are looking at the financially, the operational metrics as well together. And that will help you in strengthening your view on the company with those trends emerging out on everything.
Appreciate, Abhishek. And lastly, Aarti, a question for you, which is how you test all of us if you have to become a member, is a board is financially literate when it can. If I have to pose that and complete the sentence, which we go back to our schooling days, we'll all get younger now. What would be your view? What is that one thing? A board will be financially literate when it can?
When it can ask the right questions.
Asking questions rather than looking at numbers per se. Fair point taken. Appreciate Sushmita, Abhishek, and Aarti, all of you so kindly took out time and participated in this. I indeed enjoyed my conversation and I learned a lot. Buzzwords as well as fundamentally based ideas that could help build financial acumen and board. Thank you so much, IOD, for making this panel happen and this conversation happen. Thanks for participants being patient and being part of the journey with us. Back to you, Kashish, for guiding us through to the formal closure.
First things first, a 10 on 10 rating when it comes to how engaging and how enriching the session was. Since we were speaking of ratings, I'm sure everybody has had their fair share of takeaways, and everybody has also gotten the opportunity to draw from your respective experiences. Again, very sincere thank you to all the esteemed panelists and our moderator for giving us the opportunity of looking into something so insightful and taking this with us for our days to come. And as the webinar draws to a close, on behalf of the Institute of Directors, India, I extend our sincere gratitude to our distinguished speakers, moderator, and all the participants for joining us and contributing to the success of the webinar. We look forward to welcoming you again to future IOD programs and thought leaders. Thank you, everyone.